Close your eyes and picture investing. What do you see? Screaming men in suits, red arrows, green arrows, phones ringing off the hook, numbers flying. Madness. It looks fast, loud, ruthless. It looks like something you'd never want anything to do with. But here's the truth. You're already in it, right now, today. You're investing, and you probably don't even know it. Let me show you what I mean. Meet Bob. Bob just graduated, landed his first real job. First real paycheck hits the account. He's happy for about 10 seconds. Then he notices it. The number's smaller than it should be. There's a chunk missing, some line called 401k. He has no idea what that is. So he calls his dad.
Dad, why is my paycheck smaller than I thought? What's this 401k thing?
His dad sighs, the sigh of a man who's had this exact call before. Relax. Nobody robbed you. That's your 401k. Retirement fund. They take a little out of every paycheck, invest it for you. You don't have to do anything. Pick something off the list. Forget about it. Bob squints at the menu on his screen. S&P 500. Total market. NASDAQ. A dozen things he's never heard of.
So which one do I pick?
Doesn't really matter. Pick whatever. Because the market is always going up. Just bet on the market, not your ability to pick winners. And Bob, 22, watches way too much tech YouTube, pays for 3 AI apps he never opens. Bob lights up.
NASDAQ, that's the tech one, right? I believe in AI. I'm basically an early adopter.
His dad doesn't even look up. Sure you are, son. Bob clicks it. Feels like a genius. Goes back to his day. And that's it. That's the whole decision. 30 seconds, one click, a kid who thinks he's smart because he likes robots. But neither of them actually knows what just happened. So let's back up, and let's ask the simple question, what exactly is a 401k? Your employer sets up a retirement plan, they give you a menu of funds to pick from, you choose one. Money comes out of every paycheck automatically, goes straight into that fund. You don't lift a finger. And here's the key part, almost all of those funds buy the same thing, the winners. Not random stocks, not every company out there. The winners, the ones the market already crowned. You buy them and you just hold them. You pick it once. Then you forget about it. For 40 years, that money sits there, holding the winners. That's passive investing. You're just buying a shelf of winners and letting them do the work. And that idea? It came from one man. His name is Jack Bogle. In 1976, everybody thought he was insane. He said, don't try to beat the market. Don't hire a genius to pick stocks for you. Just buy the winners. Hold them forever. Charge almost nothing. People laughed at him. For the next 50 years, he was right. Because here's the thing. When you buy the index, you're not buying blind. You're buying winners. Real ones. Every company on that shelf earned its place. Apple beat Nokia. Beat BlackBerry. That's a winner. Microsoft proved itself. Amazon proved itself. They survived. They grew. They earned the spot. So when you buy the index, you're buying a basket the market already vetted. The losers drop off. The winners stay. And the cost? Almost nothing. You're not paying a manager to pick stocks. You're not paying research teams. You're not paying trading fees every single day. You just buy the winners, hold them forever. Pay almost nothing. And it works. 92% of professional stock pickers, people paid to beat the market. They lose to this over 20 years. The people doing nothing beat the people doing everything. So Bob's dad was right. His 401k is passive. And passive is the smartest move most people will ever make with their money. 5 years later, Bob checks his 401k. He picked NASDAQ. It's up a lot. He feels smart. But he has no idea what's actually in there. No idea what made it go up. He just knows. Passive works, right? You buy the winners. And that's exactly the problem. Because the whole thing only works if someone else decides who the winners really are. So who decides? Let's look at what actually happened. 1990. Passive investing didn't exist yet. 1, maybe 2% of the market. 1996, 6%. 2010, $1.05. 2020, 40%. Today, more than half of all the money. 92% of professional traders, the ones paid to beat the market. They lost to passive over 20 years. The dumb money beat the smart money, decade after decade. But why it won, that's the whole game. Meet the active investor. What does he do all day? He trades. Hunting one thing, the right price. Too cheap, he buys. Too expensive, he sells. And when 1,000 of them fight over one stock, every single day, a real price drops out. A number that holds every fact, every rumor, everything known about that company, baked into one honest figure. That fight has a name. It's called price discovery. That's what active investors really make. Not money, truth. Price discovery is how the market figures out what something is actually worth. Now, here's where the passive investor walks in. He doesn't research, he doesn't trade, he buys the winners and goes to sleep. But he gets the truth anyway. The active guy's already baked it into the price. Passive just copies their homework. For free. That's why passive won. Not because it's smart. Because somebody else did the hard work, and passive never paid the bill. The smart money was borrowing someone else's brain. And it worked. As long as enough fighters were still out there, setting honest prices. But look at that timeline again. Every year more money goes to sleep. Fewer hands doing the thinking. Today, half the market buys without looking. At any price. In any size. If half the market is asleep, what happens to the man who controls what goes on the shelf? He doesn't have to convince you. He doesn't have to offer a fair price. He just has to get on the index, and then half the market is forced to buy him, asleep. Any price, any size. Somebody figured that out. Not a hedge fund, not a bank. One man, the richest one alive. The guy with the rockets, the robots, the memes, and zero patience for anybody who says no. Elon Musk. To understand what Elon Musk figured out, you first have to understand Bob's dad, and why he was so sure. Bob's dad has one rule. Put the money in. It grows. Simple. And for him, that rule never once failed. Because Bob's dad started investing at the dawn of the longest bull run in history. 30 years where almost everything went up. Buy anything. Wait, he didn't get rich because he was smart. He got rich because he was born at the right time. But he doesn't know that. He thinks it's a law of nature. So he hands it down to Bob like a family recipe. Just put the money in, son. It grows. There's only one problem. Bob isn't living in his father's market. Here's the market Dad knew. For 23 years it shrank. Companies bought their own shares back by the mountain. Private equity hauled the rest off the board. Fewer shares every year. More money chasing less stock. Everything floats up. That was Dad's tailwind. He just didn't feel it. Now watch what happened to Bob's market. AI showed up. And the giants that used to be light, just websites printing money, suddenly need data centers, chips, power plants. They're talking about building in space. So the companies that spent 20 years buying their shares back now have to sell them all at once. $675 billion of new stock, hands out, asking you for money. Dad's market was a vault. It floated you up. Bob's market is a pawn shop. It asks you for the money in your pocket. And the first one through the pawn shop door is the biggest IPO in history. SpaceX, $1.78 trillion, 555 million shares at $135, 75 billion raised, selling barely 4% of itself. Sounds like a winner, right? Rockets, Mars, the guy from the memes. So let's run Dad's rule on it. A winner earns the shelf. Apple beat Nokia. That's earned. SpaceX lost nearly $5 billion last year. The price? 90 times its revenue. Not profit, revenue. The number before you subtract all the losing. By Dad's rule, this thing comes nowhere near the shelf. But Dad's rule assumes one thing, that the shelf still means something, that you have to earn your way on. Watch them break that. In 3 moves. Move 1. Kill the price. Normally 1,000 traders fight to decide what an IPO is worth. That fight is price discovery, remember? Here, Musk just announced it. 135. Flat. No negotiation. Take it or leave it. Even the banks rolled over. They put rockets in their lobbies and begged for the job. Price discovery, dead on arrival. Move 2, lock the little guy in. Fidelity dropped its minimum from $500,000 to $2,000. Come on in, everybody. And once you're in, SoFi won't let you sell for 30 days. Sell within 120, you pay a penalty. The door shuts behind you. Move 3. The magic, forced buying. The Nasdaq built a special fast lane just for this. 15 days to index inclusion. The Russell, 5. Only the S&P 500 had the spine to say no. And the second SpaceX lands on that index, every passive fund on Earth is forced to buy it. Not because it's good, because the rule says so. Whatever's on the shelf, you hold. No looking. No price too high, now. Remember who picked NASDAQ? Bob. Bob who believes in AI. Bob who clicked once and went back to his day. His retirement just bought a piece of a company that loses $5 billion a year. He didn't choose it. He doesn't know its name. He's asleep, and his savings got spent for him. And they handed retail a quarter of this deal. Usually it's a sliver. Little guys piled in. Over $100 billion of orders, chasing 15. 7 hungry buyers for every one seat. When the small guy gets everything he asked for, it's usually because the smart money already left the room. Oh, and the dream they sold him? A market worth $28 trillion? A quarter of the entire planet's economy. The actual rocket business? Maybe $2 trillion of that. The rest is AI, and the everything app, and vibes. Bob bought a fantasy with his retirement and never knew he bought a thing. $75 billion isn't even enough. SpaceX needs around $235 billion by 2030. This record-smashing IPO covers less than a third. The first $20 billion just pays off old debt, loans charging up to 12%. So this was never the finish line. It was the first withdrawal, and SpaceX isn't standing alone. There's a line forming behind it. OpenAI raised $122 billion in private, now whispering about a $1 trillion listing. Anthropic, circling $900 billion. Alphabet just sold $85 billion in stock, its first sale in 20 years. Meta, borrowing $30 billion, burning $145 a year, and the moment it said so, the stock dropped 7%. One company funding the hole in the next, all of them walking toward the same pawn shop, all of them needing one thing: Bob, asleep. Now, here's where it gets dangerous. Think about Bob's dad for a second. When he started investing, the market was shrinking, fewer shares every year, so no matter what he bought, it floated up, the longest bull run in history. He didn't have to be smart. The tide did the work, and Bob inherited the opposite, a market that's expanding, flooding with new paper, hands out everywhere. And history is rude about this. Every time the IPOs come in a flood, 29, the late 60s, the dot-com peak, it was the bell ringing at the top. The insiders all selling at once. They're usually right. You're usually the one buying their exit. Remember Cisco? Year 2000. The most valuable company on Earth. Then the bubble popped. The business survived, even grew. And it still took 25 years just to climb back to that price. 25 years. To break even. That's the quiet risk in Bob's account. Not that the market crashes tomorrow. That he bought the top and waits half his working life just to get back to zero. So, is passive investing dying? No. But the environment that made it unbeatable may be changing. Passive works because someone else is still doing price discovery, figuring out what companies are actually worth. If too much money starts flowing automatically, that mechanism becomes weaker, and savvy people start to find ways to take advantage. That's the crack. It doesn't mean the market collapses tomorrow. It means valuations can drift further from fundamentals, making bubbles easier to form. And that's why active investing isn't dead. In fact, in a market where prices become less efficient, good active investors may matter more than ever. So the real story isn't that passive lost. It's that the balance between passive and active may have shifted. And if trillion-dollar IPOs keep flooding into markets fueled by automatic buying, we may look back on this moment as the beginning of the next great bubble.